Focus. Ideate. Innovate. Enable. PwC presents India Tax Talks in association with CNBC TV 18.
Private equity has played a very prominent role in providing growth capital in India. And at a time of liquidity crunch, its importance is even more pronounced in the Indian context. Now, private equity investments account for, remember, 2% of the GDP and has been growing with more foreign capital eyeing the Indian assets. Now, is this interest going to continue? Let's understand that with an expert panel with me here. The topic of discussion today is private equity landscape as well as the ease of deal making in the country. Hello and welcome to PwC Presents India Tax Talks in association with CNBC TV 18. I'm Nisha Poddar, and joining me on the panel are Bhavin Shah of PwC India, Kalpesh Jain, Multiples Equity, Nishchal Joshipura of Nishit Desai Associates. Gentlemen, so good to have you on CNBC TV 18. Let me start with a private equity view coming in on how is the Indian landscape, and over the last 5 years, how have you seen the trend change, and is it easier to do business in the country now?
So I would say in last 20 years, this private equity investment in India has moved from a $200 million opportunity to about 36 billion investments in 2018. There's about a 45 to 50 billion pool of investment available to be invested in next about 2 years' time in sectors of private equity, real estate, infrastructure, and a large part again going to distressed asset as well.
Right.
With this market volatility as of now, which is there in both public and private, the opportunity seems to be very interesting for private equity players as well. I would say in next 1 year, the investment vintage would be the most interesting one when it is exited. On the exit side, if I look at, this has been a bit subdued in last 6 to 8 months. Major reason is one of the exit is for any private equity player is primarily one of the reason is through capital markets, and that's been actually been very volatile, and it's been corrected significantly.
Yes.
So I guess next 6 months I don't see a good exit outlook as of now, but with the political stability, and if I see a stability on the regulatory side, it could again pick up very nicely.
Bhavin, coming to you, tax regulations as well as the various changes that Indian setup makes has a huge impact on the foreign investors and investors in the country. How have you seen that trend, and have we done enough for ease of deal making in the country?
So if you look at really last 5 years, there has been some significant changes that has been proposed and implemented by the government. The biggest change which has happened over last 5 years is the withdrawal of capital gains tax exemption under the Mauritius and Singapore tax treaties. Coupled with that, various changes around the AIF taxation, which has been very attractive, and we've seen a lot of funds which were earlier being set up in Singapore and Mauritius really setting their hub into India. So the big again tax changes on GST has really made a big impact for the private equity industry.
All right, and Nishchal, of course, we are at an inflection point. As Bhavin was mentioning, the GST reforms have just come in. There are various changes on the regulatory front as well, and on the legal side. How do you think your private equity investor clients view the Indian setup, and what are the key highlights that you focus on?
Sure. I think the 3 significant changes which have happened in the last 5 years as far as private equity investors are concerned. Number one, and undoubtedly the most important one, is the IBC, which has been a game changer for resolving bankruptcies in India. The second big change has been on better enforcement of contracts, which has always been a major concern for foreign investors investing in India. And I would say the third interesting change for private equity players has been allowing the private equity players to acquire controlling stake in insurance companies, which has worked out quite well with some of the deals which have happened.
Right.
And there is a lot more capital which is now available to the insurance sector because of that change. So clearly, I would say these are the three major changes that Modi government has brought in, which have been successful in implementation.
So government has been making changes to relax the FDI rules, relax the Indian setup to really attract more foreign capital, and especially through private equity, which has been extremely keen right now. What do you think, Bhavin, about the gift city aspect? Is it going to attract enough capital as the government has been really expecting?
Yeah, gift city has been a very, very interesting idea. To my mind, implemented very well thus far. The pace of change in regulations or the challenges that are identified to make it work has been really robust. Like when we identify that these are the three things that we need to do, government has been very, very prompt in correcting it. I personally think that this is going to go a long way with a lot of private equity funds looking to set up their base in Gift City. Based on my conversation with the industry in general, there is high level of interest. There's a lot being done for the fund managers tax related, there are tax exemptions and, SEBI regulations, RBI regulations, etc. are made in a way that it's easy to set up fund manager space there. But there is hardly any incentive for the investors.
All right.
So while business income is exempt, the capital gains is still taxable in Gift City.
Yes.
And therefore, an investor coming from, say, Singapore or Mauritius would pay exactly the same capital gains tax if he invests through Gift. If you can throw some carrot for the investors, make it a little more attractive, it will be really good. And it will take off in a big way. Funds are set up once in 5 years. So means every 5 years you'll have a second fund and the third fund, right? If we have some change in tax neutrality or something, where existing funds in Mauritius and Singapore are allowed to migrate overnight into Gift City, we'll have a robust infrastructure created in no time. So if there are some thoughts around that, it would be, and if government really looks at that, it would really give a big boost.
The financial community has always been very excited about this concept of Gift City.
Yes.
But whether or not, at the execution stage, it can really take over and be another second line for some of these tax havens, that needs to be seen. So Kalpesh, what do you have to say? Is it exciting the investor community enough to really lock, stock and barrel shift over here in India for the tax benefits?
So I think for an investor, more than any tax incentives or anything, stability on regulations is very important. And what I see, at least a big change when I'm looking at Gift City regulation changes, the pace at which the regulations are being changed after evaluating various aspects from industry players and markets around. The government is taking necessary steps very fast and in favor of investors to try to build that kind of a trust, which gives us a confidence that, okay, I think it's worth evaluating that Gift City. But again, going to Gift City is more for, as Bhavin said, is more for a new fund once it's set up and go there and set up and have that advantage for a manager. But I think a larger opportunity, what I feel, is for the funds which could migrate from other jurisdictions. And beyond the tax incentives, all other regulatory framework which are applicable can be eased out to get the funds jurisdictionally move into IFS.
PwC presents India Tax Talks in association with CNBC TV 18. PwC presents India Tax Talks in association with CNBC TV 18.
Nishchal, time value of money is also equally important. So time lag, the time that we give to each of, and the energy that is really dedicated to each of the investments is also very important, especially for the investor community. How do you see this aspect, and how do you weave in the enforcement of contract issue as well in the Indian setup?
So clearly, I think from a timeline perspective, we as a country need to move to the next level as far as deal making is concerned. If you look at US, the average deal making timeline is 90 days, even for large deals. In India, today, if you want to do, let's say, an NBFC is merging with a bank which is listed, you have to approach CCI, you have to approach NCLT, you have to approach SEBI, Stock Exchange, RBI, and if 281 certificate is involved, even the tax department.
Yes.
So 6 to 7 regulators if you have to approach for a deal, and each of them have their own timelines to revert.
Yes.
It results in a significant delay in the consummation of the deal.
Right.
We have seen large deals taking at least 9 to 18 months to get consummated.
Right.
And this to me is a big issue from a deal certainty perspective, because a lot of things can change in 9 to 18 months time.
Not just investments, our merger, demerger process also takes that kind of a time.
Absolutely.
But the IBC process also, Nishchal, which came up with the idea of certainty of timeline, that also has a stopwatch. What do you have to say about that?
Absolutely. I think IBC, you are right that there was a timeline given for it, but because of our legal system, things have got delayed, and which is why the recent amendment which has been brought about, that the entire process has to get over in 330 days. Let's see how it gets implemented, but there is clearly a will on the part of the government to ensure that within 330 days the entire resolution process gets over, or else there is always an option to liquidate the company.
Bhavin, of course, tax and the trust deficit with the tax officers is something which is the overriding feature for any investment for several years. How do you see that aspect, and what are the teething worries right now?
So I would say just take an example of a transaction. We're talking about deal timelines here. A significant part of our deal timeline in documentation today, Nishchal will confirm, is on negotiating tax indemnities.
Yes.
Now, what are these tax indemnities? Tax indemnities is a purchaser's obligation to withhold tax on seller's gains. Now, if a seller has invested from a country like Mauritius or Singapore, treaties are very clear that there should not be a tax. Then why do we take so long to negotiate tax indemnity for so long? The reason is that the tax office, when it implements the treaties which are negotiated by two governments, they have their own interpretations and they question it. And the worry of purchaser being caught in that tax of the seller really creates this trust deficit, first between the taxpayers and the tax office, and then between the purchaser and the seller, right?
Yes.
So we have got this various mechanism to provide certainty for the taxpayers. Like we have got advance ruling authority, we have got advance pricing agreement, which is for transfer pricing. Now these advance ruling are supposed to be again delivered in the timeline with the law says it should be delivered in 180 days.
Right.
Today, in the current context, it takes 3 to 4 years to get certainty from advance ruling authority. Now, how is it advanced? A fund life is 7 years.
Right.
They can't really have 3 to 4 years to get certainty when the deal is happening. So,
in fact, that certainty needs to be baked in while investing so that they can calculate their return estimates as well, right? And the valuations.
So maybe going to that point, right?
Yeah.
We spoke about the treaty withdrawal at the start of this conversation. It was expected. Last 20 years, India has been negotiating with Mauritius, and we got the treaty to take away the capital gains tax exemption.
Right.
Now, 10% tax is something which was, so to say, reasonable, accepted.
Yes.
Along with that change, what also changed is the period of holding for a share to make it long term increased from 12 months to 24 months.
Right.
As a private equity investor, I invest in a target company for about 4 years.
Right.
I also make investment as a VC investor at multiple points in time during the target company's growth phase. I'll always have part of my investment which will be held for less than 2 years, part of my investments held for more than 2 years.
Right.
10% tax applies for investments which are long-term, held for more than 2 years. the tax rate for short-term capital gains is 40%. Now that's unheard of in any developed country, right? No, most countries don't tax capital gains tax at all. Don't apply capital gains tax. On listed shares, the short-term capital gains tax is 15%. On unlisted, it's 40%. That's like really punitive. And again, as I said, private equity investors invest at multiple points in time, and therefore the average tax rate actually goes significantly high. Now, so that's something which really needs to again be reviewed and reconsidered.
Right.
Just a couple of, again, one more example on this is the target companies, which are the portfolio companies, they have corporate actions like issue bonus shares, and that can happen at any time during my investment period. On bonus shares, again, the cycle of period of holding resets. So if I exit within 2 years of, bonus shares issuance, I pay 40% tax.
Right.
Now that again creates uncertainty. So these are the challenges which are not baked in at the time of investing. Sorry.
All right. So tax tangles really continue, and Kalpesh, you agree that the tax system needs to make investments much more attractive.
Yeah, I think that's important. Somewhere, if having a one set of tax regime and more stable regime is very, very critical.
Yeah.
I think there's the other side of this whole thing is a lot of time go into discussing this tax topic on the deal, which is time, effort and cost.
Yes.
It increases the cost as well. As Bhavin said, tax indemnity becomes critical. It finally lands up as insurance.
Yes.
Because of two reasons. One, the timeline it takes to if you go to another path of tax indemnity. And second is a trust deficit, that whether after getting this as well, do I am secure on the tax side or not?
Yes.
This, in fact, would increase with my estimated deal cost of about 1 to 2% if I go with the tax insurance.
Right.
So that's again, going back to the tax, I would say a good 15-20% of time would go in discussion on the tax topic when a deal is getting closed.
So in an IBC kind of a situation, definitely there has to be a ring fencing of the liabilities of the past for the new investor to come in, because anyways they are investing in stressed assets. So how do you see this situation still at this point?
So I think generally on IBC, my view is, it's a great legislation introduced by the Modi government. And like for any new law, there will always be teething troubles in the initial 5 years, right?
Yes.
But the good part about this entire episode is that government is working very hard and very fast to resolve these issues. Now, to answer your question on why would a new investor come in if past liabilities are going to continue, you're absolutely right, and which is why the amendments which have been made, in fact, the recent amendments clearly bring out the fact that once a resolution plan has been finalized, it will be binding on all the regulators and statutory authorities also.
Right.
So that will take care of the situation where a liability has already accrued in the books. And if the resolution plan factors the fact that this liability will be waived or partially waived, that will be binding on all the statutory authorities. Now, this amendment has just come, it might get challenged,
Right.
but as I mentioned, it's part and parcel of any new law where certain sections will get challenged and over a period of time precedents will get set, and then you will see smooth resolution of bankruptcies in India.
Bhavin, you want to make the final comments on how the trend is looking while we are transitioning towards better times.
So experiments like faceless tax assessment, we just need to see how it's going to pan out. There are, I can say, a lot of efforts made by the government to bring in reforms. I'm just looking at last 5 years data. There are about 2,000 circulars on tax and, say, RBI circulars, right? So every day there's something or the other coming, probably with a positive intent of getting things done. Along with that, there is a lot of pressure on the tax collections, which really dictates the behavior of the tax officers. So we just need to align it somewhere. The intent of the policymakers, if it can be translated into the tax office, also accepting those intent and really working towards in that with that objective, probably that will build trust with the private equity fund players and will reduce the deal timelines. I mean, just if
all right. So, Kalpesh, you want to make a quick point on the investor mindset at this point and the outlook for future?
So I would say outlook in Indian scenario is is actually changing drastically, where the deal sizes are increasing. It's more towards buyout and a control deal. Interestingly, now the investors of the fund also want to invest directly into the companies. That's the trend which is coming up. And the fourth aspect is on the impact investing, where the investor expects you to have a social and environmental impact as well doing the investment. Now, with all this coming up, I would say that the life of the fund overall needs to be evaluated. Generally, a fund life would be about 8 to 10 years. Globally, the trend is now going to a permanent capital, that perpetual basis the fund could go. I think regulators should evaluate whether there is a way that the fund can move on a perpetual basis. That would be a very interesting thing to do. Second, as Bhavin and Nishchal were mentioning about IBC process, which is a very, on a regulatory side, for an investor perspective, it's a very heavy to start with, tax issue lingering always, and then to focus on operationally within that company is a very, very, laborious aspect for a PE fund. So again, on that side, if suppose the regulatory side is very, very eased out, it could be a very good opportunity on the distressed asset side for a PE fund.
All right. So ease of deal making, regulatory aspects, tax aspects, as well as the trust deficit that needs to be built on several aspects. So those are the things that the government needs to work on, and the entire ecosystem needs to work on for better deal making and for attracting foreign capital and other capital for the growth story of India. In the end, it all boils down to right implementation. With that, thank you all, gentlemen, for sharing your expertise on this topic, and thanks so much for our viewers for tuning in to CNBC TV 18.
PwC presents India Tax Talks in association with CNBC TV 18. Focus, ideate, innovate, enable.